You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network, and I'm Kerry Lutz. Today is 7/29/21. Well, private placements. You get a lot of questions about them. How do you get into them? How do you get out of them? How do you make money in them? Can you make money in them? Is it a worthwhile use of your capital? And I can tell you from my personal experience that if you are judicious and you look for the good deals, hold out for the good deals. Don't be in a rush ever to make an investment. You can do quite well on it, as have I over the past several years. And the person you're about to hear from has done way better than me, knows, probably has forgotten more than I'll ever know. And he's young, a lot younger than me. So that says a lot. His name is Jamie Keech, and Jamie, resourceinsider.com, right? Do I have that right?
That's right. Resourceinsider.com.
Resourceinsider.com. Must reading. If you haven't signed up, sign up now. Go over there. So private placements, we should define it first. I'll let that be my job. I actually prepared a number of private placement memorandums that were exempt from U.S. securities registration, because ordinarily, right, you sell stock, you got to register with the SEC. Private placements, companies that are already public or companies that would like to go public, prepare a private placement memo, which, if I could sum it up, Jamie, and feel free to disagree. Basically, the private placement memorandum says you are absolutely insane to invest in this company. If you do invest, you're going to lose money for certain. You have almost no chance of making any money because it's the riskiest thing you'll ever do. You should just go to the casino and take your money. Effectively, that's what a private placement memo or prospectus says. And if there's anything sketchy about your management, if it's not in there, man, you're talking criminal violations here. Do I have that right, Jamie?
Well, that is a very legal answer to the question. Yeah, you're showing your inner lawyer. But here's how I would define private placement. It's the opportunity to invest directly into a business as opposed to completing a trade, as opposed to buying stock on the market where you're buying it from some other guy who is selling it on the other end of the computer who thinks he's getting a better deal than you. You are providing something that I like to call catalytic capital for a company. That means you're putting that money, your money, directly into the bank account of the company where they can then go use that cash to execute on a project, whether they're buying an asset, whether in the case of a mining company, which we focus on, they're drilling drill holes. You know that money, if spent wisely, if spent correctly, is delivering value to you as a shareholder and has the best chance of actually creating a return for yourself. So that's what I look at as private placements. You're basically buying picks and shovels for a company as opposed to trading stock. And there are real perks associated with that.
Right. And that is a great point, because the original purpose of our financial markets, besides making the intermediaries wealthy, which, let's face it, is often the case, the real reason for their existence is what's called allocation of capital, meaning that investors have surplus funds or maybe borrowed funds, whatever. They have funds and they're looking for a place to earn a good return, however that's defined. And they invest in the market to achieve these returns, which will then finance whatever activities they intend to do in the future. And I was being facetious, but when you actually read a private placement memo and you look at the risk factors, and fortunately or unfortunately, like, nobody reads these things, Jamie. And I admit that I don't even read them much anymore, other than looking at the risk factors and the management to see if there's something I didn't already know about them. But otherwise, it's like, okay, well, you either believe in the project or you don't. So also, I look at it as you're getting to buy something potentially for wholesale instead of retail. And depending upon the terms and conditions, that could greatly amplify or turbocharge your return on it.
Yeah.
Found that to be the case?
Well, I live in Vancouver, where so many of these venture stage publicly listed companies were launched, either in the mining space or the marijuana space or the blockchain space, now the psychedelic space. And something you hear people in Vancouver say quite a bit when someone pitches them a deal is, I don't want to pay retail prices. I don't want to pay retail prices. So what that means is they don't want to be buying stock for the same price you'd see it on the market. They want, as you said, wholesale prices. And I would liken it to like going to a Costco. You guys have Costco in the US, right?
Oh God, do we have them? They're all over.
Yeah.
They're packed.
It's like a Costco or a Sam's Club versus going down to the corner store by your house. You're paying prices direct from the distributor. So when we look for private placements, we're looking for prices that are cheaper than our members, that our subscribers can find anywhere else. If the company is already listed on a public exchange, we want to be investing at a pretty significant discount. And if possible, and where it makes sense, we want warrants. So this is something we look for in almost everything we do. A warrant, which is essentially a free option to buy future stock, to buy further stock in the future at a set price. So this is how at Resource Insider we spend all of our time. We go out and we look for private placement deals, primarily in the mining sector, where I can invest my money, where our members can invest alongside me. And we try to find great deals that are going to make money. And so far, we've done a pretty good job of that.
Hey, and I followed you, done a few of them companies that you've been involved in, and done quite nicely, I might add. So warrants, though, here's the thing. You got to look at the deal as if there were no warrant, in my opinion.
Yeah.
And would it be a good deal without a warrant? And if the answer is yes, then it could be a great deal with the warrant. But if the answer is no, don't let the icing on the cake hide the fact that the inside of the cake could be rotten.
Yeah, that's a good analogy. You should never bank on a warrant coming in. It's really a sweetener, right? And for people who are listening to this and they're thinking, what does that mean? An option? It means if you invest in a stock and you get a warrant worth $1.25. Now that might seem, and the stock is trading at $1. Well, that seems like an unusual thing to want to be able to have the right to buy a share at $1.25 when the stock is trading at $1. But if things go well for that company and the share price goes up, and all of a sudden you find that stock trading at $2, and it's going to be pretty appealing to buy that share at $1.25. You immediately make an extra 75 cents. So warrants can really magnify the returns on an investment. But to your point, Kerry, I think you should never bank on that happening. That's the cherry on top. You still need to invest in a company, given the fundamentals of where it's at, and you should be certain, or as certain as you can be, that you're going to be able to make money on just the straight shares.
Yeah, and it's so true. It used to be, once upon a time, warrants actually were registered and traded freely on the exchanges. You can still find stocks that do that, particularly SPACs and others. But most of the warrants that you get in a private placement are never going to trade on the market, because the companies don't really want them trading, because it gives speculators a dramatically discounted way to play a company's stock, and really puts a cap on the stock too, doesn't it?
And you see some of the bigger, more established companies, even in the mining space too, but generally the sort of more venture stage startup companies, they do not list their warrants. No.
Right. So best opportunities where you see it, and understand one other thing. As American investors south of the border here from Vancouver, we have disadvantages because when we buy at a private placement, the stock generally is restricted, meaning it's got a legend on it, and there's a whole formality of removing the legend after 4 or 6 months, and it could take several months to get that legend removed, and the market could have already basically come and gone, and you wind up pretty much out in the cold. So you have to be careful of that as a U.S. investor.
It's something we deal with we take very seriously, and we help a lot of our U.S. members deal with. So, I mean, you made a good point. You can't sell for the first 4 months or so. This is across the board for everyone, American, Canadian, European, what have you. There's a lockup period on these shares. But then once they become free trading, once you can sell them, U.S. citizens do need to remove a legend. Now, a good broker should be able to do that in sort of 2 to 3 weeks. But, as you know, particularly over COVID, there have been times where there have been big delays, and U.S. investors have to wait longer until they're able to execute on a trade and sell that stock if they choose to do so.
Yeah. So obviously, I wish they got done in 2 to 3 weeks. But sometimes you get surprised. Sometimes they happen a lot faster than you think. But it's just something as an American investor that you need to be aware of, because your time frame is going to be extended versus people who are not Americans don't have to. This comes under Section 144 of the SEC, and it's a real antiquated kind of provision there. Not so much the listing, but the removal. They should automatically expire upon the blackout date, but they don't. So the company has to affirmatively get them removed for each shareholder. So it can be problematical, but sometimes it works to your advantage and sometimes it doesn't. So you have to be aware of it. But so what kinds of...
You're still doing private placements, is that right?
Yeah, I still do them.
So you find the rewards kind of outweigh the challenges even for an American investor?
It's an added risk, but for certain, I do believe that the benefits, can well outweigh the risks, well outweigh them. So, yeah, I mean, but if you're a trader and you go like crazy over this stuff, then maybe not. But but I'm in it generally these companies for the longer haul, right?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
That's right. I mean, we typically look at things from, the minimum of a 6-month time frame, but often we're looking at trades that last as long as 12 to 24 months. And that's where we found our biggest returns. And we're able to sit a little bit more patient. We're not trying to get off our stock on day one. And this is the situation where we found ourselves making 2, 3, 5x, occasionally 10x return. We recently had a 10x return on a company called Kingfisher, but it did take us almost 2 years. They were private for a long time. Now, I'm willing to wait 2 years for a 10x return any day, but that might not be the right risk profile for every investor.
Yeah. Hey, well, I was telling you pre-call, my 2 earliest things, and this going back over 20 something years. And I guess we didn't really talk about accredited investors, but you have to meet certain net worth, certain liquidity guidelines. Nobody is out there checking you. It's a self-certification, but that's so that if things go wrong, You can't say, well, I'm a widow or I'm an orphan and I invested my last dollar in this thing because you said it was so great, so I'm going to sue you. No, you have to be accredited, and that protects you and it protects the company especially. So the first one I ever had, it was called, I just remember the name, alcohol sensors. And there was a thing, it was like maybe 25 years ago, that when it was an emerging thing. You put this sensor on your car. If you had a DWI, you had to blow into the tube, and if you blew over the limit, your car wouldn't allow you to start. And the company mapped out a great strategy. I put in not a lot of money for then or for now, but a good amount, and the thing like doubled or tripled, like maybe quadrupled, literally within days of when it was listed. And I think I was past my lockup period, and I sold it. The guy was really upset that I sold it, the broker, but I did sell it. And then the same guy came up with something called failsafe, and I put a little bit of money into failsafe, and that was a thing that would automatically detect a fire in your fume hood in your kitchen or under the hood in your car, and would extinguish it with a very rapid responding fire extinguisher. That company, they kept getting more and more investors, diluted. And the last I heard, it doesn't exist anymore. If anyone has heard of failsafe and you know what they're doing, just hey, drop me an email at kl@kerrylutz.com. But I seriously doubt you will. But and after that, I kind of never did them until the past 4 or 5 years.
Yeah, and I think you kind of make an important point there, because we deal with a lot of investors and would-be investors that want to learn about private placements and how they work. And common mistake we see is that people sometimes look at these things as a magic bullet, as if it's something that's absolutely definitely going to make money, because that's how industry insiders and big names do it. So therefore, it must be it's a secret cheat code that always works. And while it does give you a massive advantage, I think, and there are the opportunities for big returns, you really got to do two things correctly. One, you've got to choose the right deals, because there are a lot of shitty private placements out there if you don't know how to differentiate the good from the bad. And two, you need to build a portfolio. The way we look at it, we always have a portfolio live of at least 10 companies. We spread our risk across those companies. And we know some are going to work out and some are not going to work out. So, as of today, our portfolios return investors 130% from inception. Now, we've had stocks that have given us 10x returns, and we've had stocks that have been cut in half. And the way we manage this risk is building a strong, sort of versatile, robust portfolio that can handle the ups and downs in the market, that give out the control for management risk and jurisdiction risk and geological risk and all these things. And anyone who thinks, one company is going to set them up for retirement, so bet the farm on it, is, I think, making a very grave mistake.
Yes. And probably shouldn't put it in your retirement account, because a loss is probably more likely than on your regular stock trades. And if you get a loss, you want to be able to utilize that loss on your taxes. You put it into your retirement, it's a no-go, because that just lowers your total return in your retirement account. You can't write off that loss against your profits. So just something to be aware of. I think it's really important. And I don't know, is there anything else you think we should cover here, Jamie, as far as private placements goes? What's the average amounts invested? Like lately I've seen 25 to 50, something like that. What do you think?
It really depends, and it really depends on the company. So the company gets to set if there's a minimum amount to be invested. But I think this is actually one of the big misconceptions of this space, is that people think that to do private placements, you've got to be a millionaire or a hedge fund or something like that. But, a resource insider, when we cover a deal and we bring it to our members, we've got guys that come in for, $200,000, but we've also got guys that come in for $2,000 or less sometimes. And, this is not just investing for the rich and famous. This is really investing for anyone that is an accredited investor, has an interest in putting the time and energy into learning how to do this. So the average investment we get on our deals is about $15,000 to $20,000. But again, there's a huge range of what people are willing and comfortable coming at.
Hey, and I would recommend if you're getting into this, you're something you want to do and you really think it's a good idea, you know what? Don't bet the ranch on your first one. Do figure out how much money you have to invest in it and then invest half for the first 3 or 4 of them. Get familiar with the process, understand legend removal, especially if you're a US investor, and understand how the companies work and what they do. And then once you're comfortable, then you can up the ante. But look, like it said, Jamie, on Wall Street, you never lose money taking a profit. Well, you know what? You never lose money by risking less money than you might have otherwise risked, right?
Exactly. And if I could make an offer to your listeners, Kerry,
please.
So next week, August 5th, we're actually hosting a live webinar where we're going to be giving a course to anyone that wants to sign up on how to actually conduct and participate in private placements, how to go out there and find deals, how to set up a brokerage account, how to evaluate the good to the bad. So all you have to go is go to resourceinsider.com, sign up for a free email address, and you're going to be able to get invited to that. So our space is limited. We've got sort of slots filling up pretty quickly, but there are some spots left. So if you're interested in kind of getting what I would call a bit of a master class on private and placement investing, please do go sign up there. And, if you have any doubts on the validity of this kind of investing, I'd also recommend you just send me an email. It's jamie@resourceinsider.com and ask to see our portfolio. And I'll send you every single trade we've ever made at Resource Insider. You'll get to see what price we bought a stock at, bought a private placement at, and what price it's trading at today. So it'll give you a good idea of the return potentials here if you do the right investments. So jamie@resourceinsider.com.
And it's the transparency is great because you can see the winners and the losers. There have to have been a few losers along the way, right?
Yeah, there have been losers, but our winners have massively offset that. And again, that was part of the nature of this sort of investing is you don't know what it's going to win and what's going to lose. Often we're investing in early stage exploration projects. There's a lot of ambiguity and opacity. And so it's about building this strong portfolio that's highly levered to success.
Hey, and I love the fact that you're transparent about your record, that you share that with the potential subscribers and investors so they know where they stand right away. And obviously, like every Wall Street brokerage commercial says, past performance is not an indicator of future returns, right?
No way. We plan on doing even better in the future.
All right, and that's okay. You're allowed to surprise on the upside, Jamie. We love that. So, anyways, if you've got a question for Jamie, myself, the email address again is kl@kerrylutz.com. If you've been involved in private placements before, just share your experiences with myself and Jamie. I'll pass it along to him. I want to know how you've done on them. And it's not something I've ever really recommended to people or covered a lot. So I'm really glad you came on, Jamie, so we could really cover it. I mean, I did 14 of them myself, private placements, and I know what's involved. I do understand all the process and everything. Not thrilled about certain parts of it, but the potential gains are so high. Risk is high, but reward is higher. That's what I've always found. And just go over to resourceinsider.com, sign up for that free webinar. You will learn a wealth of information, all the pitfalls, the pratfalls that you need to be aware of when you're going to invest your hard-earned dollars into a private placement, which may or may be the right thing for you. If you're a 100-year-old person and you got a fixed income and this is all the money you have, don't even go to the webinar. But you got a couple bucks, you fall into the definition of an accredited investor, you want to be there. So just go over to resourceinsider.com and hey, go over to financialsurvivalnetwork.com, sign up for a free newsletter. Jamie, it's always really great to speak with you and catch up. And we will talk with you again real soon.
Thanks for having me on, Kerry. Very much appreciated.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.